Welcome to this month's Big Picture podcast, where we step back from the headlines to look at what's really going on beneath the surface in our economy, in our property markets, and the world of wealth creation. And a lot has shifted since Ken Race and I last spoke. Lenders are changing the rules, rates are sending mixed signals, tax policies tightening, and the ATO is sharpening its pencils. And to top it off, the ABS has released disturbing new data showing that people with disability are more likely to become victims of fraud. Now, none of these issues actually live in a vacuum. Together, they paint a very different picture of the environment investors and affluent families are operating in today. So, for those of you who don't know me, hi, I'm Michael Yardney, and welcome to the Michael Yardney podcast. Look, over 5 decades of being involved in property, I've seen almost every cycle, trend and so-called crisis, and I know how confusing many of the mixed messages we're receiving are. And that's why twice each week I cut through the clutter to bring you clear, practical insights about building wealth through property. We offer you proven strategy, smart psychology, and lessons from some of Australia's leading experts. And today I'm joined once again by Australia's leading wealth strategist, Ken Race, to unpack what all this means for property investors, business owners, and those wanting to build intergenerational wealth. So whether you're just starting out or already well on your way, my aim through these podcasts is to help you make better financial decisions so that you can grow your wealth safely through property investment and build a life of financial independence. Hey, one that gives you choices. So let's get on with our show today. Ken, welcome back, and it's the monthly Big Picture Macroeconomic podcast. There's lots to discuss today, Ken.
There certainly is. There's been a lot of water under the bridge in these last few weeks, let alone the last month. Lots to talk about. Lots of different things that are happening in our economy.
Yeah, well, I've had lots of emails this month from our high net worth clients at Metropole saying, hey, my bank suddenly won't lend to my trust. Fixed rates have jumped. What's going on? The ATO, they're targeting my holiday home. What does the New South Wales land tax actually mean to me? So I thought, let's tackle them all. There's lots to discuss. But in your area of the world, banks are pulling away from lending to trusts and SMSFs. Most notably, there was Macquarie, and there's another one of the big banks now.
Yep, CBA.
CBA is not lending to trusts, and I'm not sure about CBA with SMSFs. This is a major change in how sophisticated investor structures are going to be affected by the banks. Now, if I'm not mistaken, they're not taking away any loans they've currently got. Just to declare, I own nothing in my own name, or neither Pam or I do, and most of our successful clients own nothing in their own name but control everything through trusts or other structures. It's not just trusts. So what's actually going on here, Ken?
I think Macquarie started the ball rolling. They've got more of a blanket restriction on trusts. CBA have come out and they've got a much softer tone. They're talking if you've been a customer of theirs for a while, they put a time limit on it, et cetera, et cetera. So the issue was there was a lot of publicity about extending borrowing capacity using structures.
Sorry to interrupt you, Ken. It's not that there was a lot. There still is on social media by people who have got no right to discuss financial structures, buyers agents and others, mortgage brokers who are feathering their own nest.
That's right. So, and the banks got onto that bandwagon. And if I can, put my neck on the chopping block, I think they didn't do a lot of their due diligence on where those loans were going to be repaid from.
Yes.
And as such, like a bank does, it just cuts you off at the knees.
Well, if I could just explain for those who don't know, unlicensed financial, let's call them influencers, brokers and buyers agents, recommended using multiple trusts for the wrong reasons. They said you can have unlimited borrowing capacity. Just find a property that's got positive cash flow, and the bank will not look at your total borrowings in other entities, but they'll allow you to keep just buying one property after the other. First of all, I don't believe that was the case, but it got people to set up trusts, and some banks, I guess, loosened their criteria a little bit.
Yeah. And I think they went one step further because if they can actually see a positively geared property, that's one thing. But they're asking accountants, and a lot of them shied away from it. But they wanted a commitment that trust could repay its loans.
Yes.
And that was a pretty flimsy request, or the way they proved that. So a lot of things, I think, went through to the keeper that shouldn't have.
Yes.
But a bank at the end of the day is an institution whose business is lending money. And if they can see a return on lending money because they can get it back and they don't lose the capital, bad debts and things of that nature, then that's what they're in the business of doing. So I'm thinking that restriction pendulum will swing back a little bit and just make the criteria for borrowing a little bit tighter to actually show serviceability in a real sense.
So do people who currently have assets in a trust have any need to worry?
Well, the banks have said no, that if you're already in a trust, they'll leave it there. But I mean, periodically, if you need to refinance or if you want to go from bank A to B, then you could get caught up in this current malaise. Or if you do something where the bank wants to review your borrowing capacity, it may be that. But I think for people who've been using trusts, who've been making repayments to the bank on time, then life will go on. That's my personal view. So just make sure you keep repaying.
Yes.
Don't slip behind. And look, in many cases, banks have actually asked for a guarantee from the director of the trustee of that trust.
Sure. And that's where systems that are touted on social media don't actually work, because they say, oh, each entity will have its own borrowing capacity, but the bank still is going to want a personal guarantee from you as director of the trustee, and then they'll look at all your other borrowings. So just be careful. We've seen these schemes come and go, Ken,
Yeah.
but also along the way, we've also said that trusts are brilliant tools when used correctly. Now, we're not giving advice here. We don't know your personal circumstances, but they're a good structure when used correctly and dangerous when they're abused. So just be careful whose advice you're getting, and it should be from somebody licensed to give advice on ownership structures and not a finance broker or a buyer's agent.
And I'll just say one thing there. And I think that's where a finance strategist, a mortgage broker in the old terminology, but if you like, a sophisticated broker who
Yes.
understands the banking system,
Yes.
because the banks are still lending to trusts for commercial loans because people who go and buy a commercial building or a this or a that or have a business are predominantly run through structures. So there's another part of the bank, if you like, the non-retail, the mum and dad side of the bank, the more commercial side of the bank, who understands the trusts.
Now, we don't know if this is going to be permanent, Ken. It's very, very unlikely, because we've seen these sort of restrictions before when APRA has stepped in, when there's been restriction to investor lending, when the percentage of investor lending from various banks has been capped, when they've looked more carefully. So I think this is probably a bit of an overreaction. So again, take careful advice, and there's still lots of lenders out there who will lend to trusts and SMSFs. Again, not giving you any personal advice here, but get the right advice. Now, the other news over the last couple of weeks is that some banks have quietly lifted their fixed rates, even before the RBA has made any moves. The RBA is unlikely to make any moves for some time. Traditionally, though, fixed rates are the canary in the coal mine. They shift before official rates do. Now, the increase wasn't a lot, but what's your understanding of this?
Look, I think we've gone from an atmosphere of an expectation of the RBA reducing interest rates, and we're now faced with a dilemma where that is no longer the case. And if you're a betting person, the chances of an interest rate increase are higher than an interest rate decrease. And the banks see this. So because they're actually out there borrowing ahead of time, they have to take those into account. So two things. They're seeing the potential for interest rate increases overseas growing, and a lot of their borrowings are from overseas, so their cost of capital would go up. And they're actually seeing that in Australia. So for a bank, that's their cautious methodology. As they're seeing interest rates not falling, or not falling at the rate everyone was expecting, they will push them up, if you like, ahead of the curve so as to not be caught out. And, when we look at what the RBA's two main sticks are, it's one main stick, interest rates, but the two levers they have is they look at inflation and they look at unemployment rates.
Yep.
And inflation around the world is going up. It's certainly not going down. And that's certainly the case in Australia. and unemployment levels are at a level that isn't worrying the banks. So if you like, their need to stimulate the economy is being taken away, and therefore the cautious attitude of a bank is I'll either sit on my hands or I'll act in a way that doesn't put pressure particularly on inflation.
I guess the message is don't expect another interest rate cut anytime soon. Now, the Reserve Bank raises interest rates to slow the economy, slow inflation. Once it does that, it lowers interest rates to increase, I guess, squeeze the wheels of industry and increase spending. And it's got to find that happy medium. And a lot of people thought that final figure, that Goldilocks Reserve Bank rate, would be somewhere between 3 and 3.25. And at the moment, the Reserve Bank says, yes, its interest rate is still a bit restrictive, which in my mind means there could be one more cut, but probably not until the second half of 2026. And it'll, I guess, then bring interest rates down to the lowish to mid threes. So don't expect another period of very low rates like we experienced over COVID.
And look, if we look at interest rates, certainly I'm going to say 35 years, but from the 1990s through to now 2025, that average is only marginally higher than what the current cash rate of 3.6 is today. So the 35-year average is about 3.87. And to get 3.87, interest rates have gone 17.5 at the high end
Yes.
and 0.1 at the low end. So we're actually in that lukewarm area at the moment where we're about sitting on the long-term average. So it's almost an RBA being lazy that says, I don't have to do anything, so therefore I won't, because if I do something, I could be wrong.
They're taking a cautious approach.
Yeah.
So if you're not sure what to do, speak to a proficient mortgage broker, a property finance broker who understands a bit more than just how to get a home loan. Now, Ken, another announcement that caught some people by surprise was from the ATO, which highlighted, well, actually, it's nothing new, but I guess one of their ways of making sure people comply is by scaring us a little bit, that from July 2020, tightening the rules on tax deductions for holiday homes. A lot of people probably at this time of the year thinking about holiday homes or going on holidays. So they're suggesting that unless the property is genuinely and primarily available for rent throughout the year, including the peak season, they may not see it as the ability to deduct all the things you could before. What are they on about?
Yeah, I don't think it's not new legislation. It's not a new interpretation of old. It's there, I think, looking for low-hanging fruit. Given $1 trillion worth of debt, we're seeing that carrying the burden, if you like, of the tax intake. It's sort of more than double what companies pay, and certainly 3 times more than GST. So therefore, they're looking for low-hanging fruit, and they're now looking at, they call them leisure properties, leisure homes. And what they're saying is, if you've really got an investment, you would be of an investment property. If it's a real investment, you would be maximizing your rental income.
Yes.
And that means you would be renting it out in the peak seasons, because that's when you're going to get your peak dollars.
Of course.
So if you don't do that, maybe you've got an alternate use of that property for your own personal use. And therefore, it should not be fully tax deductible. So they're still going to give you the tax deductions for while it's being rented, but a lot more proportionality, obviously, for the advertising, for the cleaning in between tenants, et cetera, et cetera. So with access to Airbnb and the other platforms for share of housing, rental housing, short-term rental housing, they've got access to a lot of statistics from property managers. And they've written, as I understand it, quite sophisticated AI to look at an individual's rental income of when it would have been generated. How they do that, I'm not quite sure. But obviously, it's the average for the year and where is the property, et cetera, et cetera. So the computer is going to spit out the initial question, and it could be, when was the property rented? So I think there is going to be that clampdown. And if there was an average 20-odd thousand deduction, predominantly for interest, on holiday homes being rented out, then there's a lot of money to be lost by the owners of those properties, but equally a lot of money to be picked up by the ATO. to help, if you like, pick up that tax gap.
Well, a couple of months ago, you and I interviewed on this podcast the Assistant Commissioner of Taxation, and it's very clear that they've spent a lot of money putting systems together to scrutinise expenses, and property investment deductions is clearly one of the areas of their focus.
Yeah, I mean, restricting negative gearing, changing the capital gains tax, all those things are big things to sell. And there's a lot of, if you like, groups that will fight them. Whereas this is a fairly simple, bland thing to do. And I think there's a few more like this that the ATO will target. And they're certainly looking at, for investors, writing off something as an expense that should have been capitalized, et cetera, et cetera, et cetera. So that's the way I think the ATO is initially going to tackle this issue of how to get more tax out of property investors.
Well, we know they're not going to take less tax out of us.
No.
So that's why it's important to get the right advice even before you buy your investment property, understanding the right ownership structure for you. It would be different if you're a PAYG earner, if you're a professional, if you own your own business. And that's one of the things the team at Metropole help, because while a lot of people know us as buyers agents, and we're really proud that we've just won 3 awards last month from finder.com.au as Australia's most trusted buyer's agent and best buyer's agent. We're much more than buyer's agents. We help our clients safely grow, protect, and pass on their wealth through giving strategic property and wealth advice. We do not give wealth advice through this podcast, so the discussions Ken and I are having are of general nature for obvious reasons. We don't know your situation. But if you want to understand how some of these things will impact you, or more importantly, how to take advantage of this coming year, 2026 is going to be a year when every property market around Australia, all the capital cities are going to still keep growing and reach record high levels. All the forecasts are already starting to come in for 2026, and all the economists are agreeing with that. But not all properties are investment grade. And you've heard us say it before, you've really got to start with a plan. So the property you eventually buy should be the physical manifestation of a whole lot of decisions you make. And part of that is having a right plan to start with. So if you're wanting to take advantage of the opportunities that 2026 is going to give, I know it's getting near the end of the year, but get your ducks in a row for next year. So go to metropole.com.au. I'll leave a link in the show notes and have a chat with one of our wealth strategists so you can start the year off in the right way. Continuing on with taxes, you wrote an article on Property Update, another big one about New South Wales's frozen land tax thresholds. Have they been paying attention to us down here in Victoria? That's going to be a bit of a worry for people. It's going to increase their land tax exposure.
That's right. So New South Wales has, if you like, followed the property price cycle up, and they have, if you like, passed on the bulk of property value growth into their land valuations. And they've been doing it quite consistently, whereas, at the moment, the threshold for an individual is $1,075,000, which, if you compare that to 50,000 maybe in Victoria, 600 odd thousand in Queensland, some people said it was a very generous offering, if you like. So they've decided to freeze it, which actually means that over the coming years, their intake of tax through land tax will grow. And when we look at New South Wales as a state, approximately 50% of the tax they collect is from property-related activities. 50%. So that will now only grow. So they've just seen it as a way to plug up a bit of their budget black hole. This was, if you like, a soft way of doing it. We'll just freeze the increase. There's no threshold for trusts in New South Wales, so they collect land tax from the first dollar. So the individual one was the one that has been going up and up. And the other thing they've done behind the scenes, they've tightened up the way they group different owners. So before, if a husband owned a property and a wife owned a property, that was two separate entities. Whereas now they can start talking about related parties, associated parties, and group them. And then you only get the one threshold. So they're doing a few things there. And I think bracket creep is inflation is actually giving them more. And on the other side, the flip side, which is, the silly thing, is as property rises, property prices increase, they get more stamp duty. So they'll get more stamp duty and they'll get more land tax. So watch this space.
Well, again, my message to people watching us and listening is don't let this scare you and don't start considering selling properties. First of all, land tax is the only tax that's tax deductible, so at least you get a benefit there. But Ken, I remember many years ago when we were doing seminars around Australia, once at the Wesley Centre in the centre of CBD in Sydney, a lady came up to me and she said, I want to sell my properties in Sydney. I'm paying too much land tax. Now, this was 10, 15 years ago.
Yes.
She was paying, I can't remember, $10,000, $15,000 land tax. Sure, it was a lot of money in those days. Having said that, I talked her out of it. I said, it's not a fine for being a property owner. It's a fee for being in the property investment game. Don't see it as a negative side of things. How much of your property's gone up in value? Now, I hope she didn't sell her Sydney properties 15 years ago because they would have doubled and probably almost doubled again. And sure, the land tax would have been a little bit of a cash flow nuisance, but it's just a cost of doing business, Ken.
It is. And I'm more worried about the insidious nature they value the land. I mean, if they tell you this is the land tax threshold and then you'll pay land tax, that's in your face, you know it. But the Director General is actually valuing a lot of land, I think, well above a realistic market value.
Interesting.
And therefore, they're picking up more land tax. The other thing that trickles down is into council rates, because most council rates are predicated on those values. So if you think your land values are going up, can I say disproportionately to the market that you're seeing, don't be afraid to look at putting in an objection. Yes, it's a little bit costly. It's certainly time consuming. But if you do your research in enough detail to give you a sense that you are being ripped off, if you like, then I think an objection shouldn't be off the cards.
Well, one of the things we do when we put a strategic plan together for clients at Metropole is use very powerful software with a whole lot of inputs. So the inputs there will show what the implications of paying extra land tax are. In Victoria, there's different land tax thresholds as well. And if you're buying a commercial property in 10 years' time, there's going to be a 1% fee on commercial property land values. So we put all those assumptions in and then work out what that really mean to you. So I'd be suggesting that people don't make investment decisions on gut feel or emotion or fright, but really based on evidence. So if you want to understand what this means for you, what it could mean for you, go to metropole.com.au and organise a complimentary wealth discovery chat with one of our wealth strategists and see if having a plan written for you to help you plan to become the investor you plan to become is the right thing for you. I'll leave a link in the show notes. Go to metropole.com.au.
One more thing on that, Michael. That's why a plan is so important, because if you're only going to buy one property, fair enough. But a lot of our clients are buying multiple properties. So diversification of geography becomes important, and the type of properties you're buying is important. And that then has an impact on the land tax liability that you'll have.
Yes.
So have a look at that as part of that strategic plan in the location, i.e. which physical state and which type of property.
Thank you for explaining that. Now, for the last topic I'd like to discuss today, it's a bit different for a property podcast, but it did actually catch my attention because it highlights how vulnerable people can be financially. It was a press release by the Australian Bureau of Statistics, which showed that 18.1% of Australians with disability, almost 1 in 5, experienced fraud last year compared to just 12.9% of the community without a disability. Ken, that's a huge gap.
Look, I must admit, I hadn't focused on this until you identified it as a topic for this podcast. I was gobsmacked at those statistics, at, if you like, the way a lot of people in that disability sector is treated vis-a-vis the non-disability. And something as simple as credit card fraud. And, we know in a lot of instances, if the credit card holder has done the right thing, the bank actually reimburses the individual. But From this report, we saw that the disadvantaged people with disability are less likely to get a full reimbursement than a non-disability person. I mean, that's just why. Why would a bank differentiate? And the prevalence of fraud against people who are disabled is particularly driven, when I was reading into between the lines and actually the statistics, by people they know under their own roof, if I could put it that way.
Yes.
Whereas a lot of fraud, a lot of those sort of identity thefts are done by strangers outside of the family home. So I think if you are in that group of people, you've got to just, I think, take stock. And I think if you're a guardian of one of those people, even more so. And that's why we at Metropole Wealth Advisory talk about disability trusts as one mechanism. There's a couple of things that you can do that help protect, if you like, against something erroneous like this happening. And I think more and more we've got to start thinking of these things and take action.
Well, if you're got somebody in your family who've got challenges, disabilities, or other problems, and you're interested in that concept of how you can protect them, as I said earlier on, I'll leave a link to metropole.com.au in the show notes and have a chat with Ken and the team at Wealth Advisory to understand how you could do that. The way they were fraud against these people with disability, the big one was card fraud, but they were also more likely to have scams, identity theft. But yes, it is a real shame. And I do remember reading that story a number of years ago also. The fraud often occurred from people that they knew, somebody in the family taking advantage of them, and that's a real shame.
I think the elderly as well as very vulnerable.
Yes.
So we advise a lot of our clients that, when you're doing your estate planning, yes, have a will, and there's different types of wills you can put in place to create stronger safeguards. Guardianships, so if your family is going to put you into a aged care facility, what level of aged care do you want? 3 decent meals a day, or do you want
Yes.
wine with your dinner? I mean, I'm being a bit frivolous with those comments, but that's the level of detail you go into to say, well, at least I know that I'm going to be looked after the way I wanted when I'm not in a position to help myself. So guardianships, directives, all those things I think have to be done. The other one we're seeing a lot is, can I say, the younger generation pressuring the older generation, particularly with super death benefit payments.
Yes.
Because money going out of super on the death of a member to an adult child is taxed quite significantly, 15% plus Medicare. And if there's a life insurance policy in there, it's 30% plus Medicare. So there's a lot of, if you like, unscrupulous activity to get the elderly to take that money out before death so that these younger generations don't pay those taxes, which is not necessarily the best advice for the elderly person. So you've got to think of a number of these things. Cyber risk is critical. We had a client who came in and their partner had passed away and they had no idea where the money was. They had no idea of the bank accounts, the passwords.
Passwords is a big one.
So you've got to keep all those things front of mind and actually have them available in a way that is protected, but is available to that next, if you like, relative who's going to have to look after your activities, the executor of your will, because
I actually use a program called Evernote. I've used it for years.
Yeah.
Pam and I have access to where all the part. It's very secure, and you can have a free version. We have a paid version because I leave a lot. It's my electronic filing cabinet, but it's got all the passwords and it's got all the information there, so that Pam or whoever will have access to those in the future. Evernote, you just look it up, and it's something I've used for over a decade. I'd highly recommend to people.
You mentioned passwords. I was reading something, it was about a year ago, one of the banks was delaying payment of someone had been defrauded, money got taken out of their bank account. The reason the bank gave was you hadn't changed your password in X period of time.
Really?
And therefore you're more susceptible to have it broken into because it's been the same for years. So have a look at strong passwords. I think change them periodically and have them located in a place that the next person can get to it when the inevitable happens to you.
Well, Ken, thanks for decoding so many complex issues today, from the lending restrictions to fixed rates, tax creep, ATO scrutiny. What we're really highlighting that wealth isn't just about buying assets, it's about the right structures, the right strategy, risk management, resilience and foresight. And these aren't the issues that the average investor can navigate alone. So if you'd like to explore how to better structure your investments, protect your assets, build more resilient long-term financial plans, speak with Ken and the team at Metropole. Go to metropole.com.au. And if you'd like to catch up with Ken and me personally, once a year we run Wealth Retreat on the Gold Coast. It's the last weekend of May, where we've got a fantastic faculty of experts, including Simon Kirstenmacher, Brett Warren, Ken Race, Greg Hankinson, Mark Creedon, a whole lot of people. Go to wealthretreat.com.au and make this the year, our 20th anniversary year of Wealth Retreat, so that you join this elite group of investors. Ken, thank you very much. Look forward to our next month's Big Picture podcast.
Thank you, Michael.
Regular viewers and listeners know that each show I ask you a property trivia question and give 3 people a chance to win a book each week. Now, these are hard copy books, not ebooks, and today's question is based on the discussion I just had with Ken Race. True or false question, leave your answer at propertytrivia.com.au. And if you're not lucky enough to win the book, you're definitely going to get an updated report about our housing markets. True or false, in New South Wales, the land tax threshold now automatically increases each year to keep pace with rising land values. Now, you listen to Ken and me, so you should know the answer. True or false, in New South Wales, the land tax threshold now automatically increases each year to keep pace with rising land values. Go to propertytrivia.com.au, leave your answer, and I'll leave a link in the show notes just to remind you where to go.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
As always, I'd like to finish today's show with a mindset message. And today, it's, I think, particularly relevant in the current environment where the rules keep shifting, where lenders pull back without warning, when tax laws tighten, when the ATO seems to have a magnifying glass looking at property investors more carefully. There's a temptation when you see so many changes at once to slip into fear mode or to assume the game has somehow got harder. But here's the truth, and it's something I've witnessed repeatedly over my 5 decades investing. The game hasn't got harder. It's simply become more selective. The people who thrive in the next decade aren't the ones chasing the latest hotspots or relying on simplistic strategies or hoping the banks are going to keep saying yes. They're the ones who embrace complexity, who learn faster than the market changes, and who understand that turbulence isn't an enemy. In fact, turbulence is often where the real opportunities lie. So think about what Ken and I discussed today. Every single challenge we covered, lending, tightening, fixed rates, the ATO scrutiny, land tax creep, is also a filter that weeds out the speculators, the poorly structured, the over-leveraged, and those who rely on the wrong advice. And when the market gets filtered, those who are left standing gain the greatest advantage. So the mindset I want you to adopt is this. Don't fear the tightening. Use it as a competitive edge. Most people react. Sophisticated investors adapt. The wealthy investors, they actually anticipate. Your job isn't to predict every twist and turn. Your job is to become the kind of investor who can handle whichever twist and turn comes next. That means stronger financial buffers, better ownership structures, more proactive planning, and surrounding yourselves with the right experts so you can see around the corners before everyone else does. Uncertainty isn't a sign to retreat. It's a sign the cycle's setting up for the next wave of opportunities, and only those with the right mindset will be prepared enough to seize them. So my message to you to finish off today's show is stay strategic, stay curious, stay in control, and keep playing the long game, because that's where and how real wealth is created. Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this, or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney Podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. And I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney Podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcast, there are 3 little buttons at the top of the player. Or just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour, and you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney Podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?